Okay, so let's dive right in. We've got some pretty big financial news today, something that feels like, well, a significant signal. Another major credit rating agency, Moody's, has just downgraded the U.S. credit rating. And today, our deep dive is all about unpacking this specific move. Moody's deciding to shift the U.S. from that top rated rating down to AA1. We're really focusing on one article here that lays out the details. So our mission really is to pull out the key insights for you from this source. Why now? What did it do to the markets immediately? What are the sort of longer-term ripples? And what's the bigger picture here?
Yeah, and it's crucial, I think, to remember this isn't happening out of the blue. The article makes a point of saying, this follows Fitch doing something similar just last year, 2023, and S&P did it way back in 2011. So Moody's, it's framed as kind of the latest step in an ongoing trend.
Okay, right. So let's get into the why. The source must have specific reasons Moody's gave. What were the main things mentioned?
Well, the absolute core issue highlighted is the escalating U.S. debt. The article cites the current federal debt at over $36 trillion, which is already a huge number.
36 trillion, yeah.
And then it points to CBO projections, that's the Congressional Budget Office, suggesting another $23.9 trillion could be added over the next 10 years. It even mentions specific legislation, like something called the Big Beautiful Bill, possibly adding, another $5 trillion on top. Just gives you a sense of scale.
Wow. That's just a lot of zeros. And the article really leans into the political side, too, the lack of consensus.
Exactly. That's a huge piece of it. The source highlights that basically neither major political party has presented what the analysis considers a viable plan to really tackle the deficit in a serious way. So it suggests this deep structural fiscal imbalance and maybe a lack of political will to fix it. And it adds another layer by comparing the U.S. to other countries. It points out that our debt to GDP ratio, and importantly, how much it costs us to service that debt, well, those metrics now look worse than many other countries with similar credit ratings.
Ah, okay,
Yeah.
so it's not just the total amount, but it's getting more expensive to actually carry that debt.
Precisely. The rising interest costs are stressed in the article. Interest payments are getting close to $1 trillion a year. And that's expected to grow, partly because the Fed's keeping rates higher to combat inflation, but also just the sheer size of the debt keeps growing. And here's something interesting. The article picked up on the market was already showing signs of stress before the official downgrade. It mentioned weak demand in some recent Treasury auctions. I think it specifically called out the 20-year bonds.
Oh, really?
Yeah, demand was apparently soft enough that yields the return investors demand they spiked up to 5%, the highest since, 2023, apparently. It's like a signal, right? Investors getting nervous about the U.S.'s ability to handle its debt if rates stay high or deficits keep climbing.
Okay, so that covers the rationale, the why. What about the immediate aftermath? What did the analysis say about how markets reacted right when the news hit?
Well, it definitely describes a significant shakeup. Volatility jumped. The Dow Jones dropped over 800 points. The S&P 500 fell about 3.2%, and the Nasdaq was down even more, like 4.1%.
Oh.
And some sectors felt it more than others. The article mentions banking stocks, for instance, big names like J.P. Morgan Chase, Bank of America. They apparently lost something like 6 to 8% of their value pretty quickly.
And that market fear gauge you hear about, did that react?
It did. The VIX, the CBOE volatility index, the article says it surged 11% in just one trading session. So clearly increased anxiety in the market. And that stress in the treasury market we talked about, the article connects the dots. It says that weak demand for the longer-term bonds kind of made things worse, leading to this thing called yield curve steepening.
Okay, what does that mean exactly?
Basically, investors demand a much, much higher return for lending money for, say, 30 years compared to shorter terms. The yield on the 30-year bond hit 5.1%, according to the piece. It signals they see more risk lending to the U.S. government long-term.
But I think you mentioned the article also included some perspective that maybe the sky wasn't falling entirely.
That's right. It did include some analyst views, mentioned one from Allianz, I believe, suggesting that while it's big news, the immediate market chaos might be somewhat contained.
And the reasoning there.
It often comes back to the unique position of the U.S. dollar as the world's main reserve currency, and the fact that realistically, there aren't many other places for global capital to go that offer the same scale and, historically at least, safety as U.S. Treasuries. There just aren't perfect substitutes right now.
Got it. Okay, so moving beyond that first reaction, what about the longer-term economic stuff the article flags?
Well, looking ahead, the big implication is that higher borrowing costs for the government itself could force some really tough choices. things like spending cuts or maybe tax increases down the line.
But didn't the article also say the politics make that unlikely?
Exactly. It kind of highlights the irony. The same political gridlock that contributed to the downgrade makes enacting those kinds of major fiscal reforms seem, well, pretty difficult in the current climate. The article also brings up the 2017 tax cuts specifically, points out they added to revenue shortfalls, and notes they're set to expire in 2026 anyway, which just adds another layer of fiscal uncertainty.
Okay, this is where the article got really interesting for me. It talked about investors changing their behavior, making shifts.
Yes, this was a fascinating part of the analysis. It identifies what it sees as a clear trend. Investors increasingly looking for ways to hedge against all this fiscal uncertainty.
Mhm.
And where are they going? Towards hard assets, specifically gold and silver.
Right, hedging against uncertainty.
And it gives specifics. It notes central banks around the world have been huge buyers of gold, purchasing over 1,000 tons annually for the last 3 years straight. The source expects that to continue, maybe even accelerate.
1,000 tons annually for 3 years.
Yeah, massive amounts. And it doesn't stop there. It shares some pretty eye-popping price projections, cites institutions like JP Morgan, WisdomTree, suggesting gold could potentially reach $4,000, maybe even $5,000 an ounce.
Wow. Okay, so what's driving that? Is it just the usual suspect, people worried about inflation?
Well, this is key, and the article is very specific here. It argues this shift isn't primarily about inflation fears. It's more fundamental. It's about a decline in confidence in traditional paper assets,
Hmm.
meaning fiat currencies like the dollar itself and sovereign debt, government bonds. It suggests a growing unease about the long-term value and stability of those core financial instruments.
That's a significant claim. And the article connects this back to the political situation pretty directly, doesn't it?
Oh, absolutely. It does not mince words. It talks about partisan gridlock and this persistent inability of policymakers to get deficits under control. The analysis frames it as a real erosion of fiscal discipline over time.
Not blaming one party specifically.
No, it states pretty clearly that both Democratic and Republican administrations have tended to prioritize, short-term goals or stimulus over long-term fiscal health. And the consequence, according to this analysis, it potentially undermines the credibility of how the U.S. manages its economy on the world stage, and could even speed up the movement of capital away from dollar-based assets towards other things, that capital flight idea.
Which leads to the global picture, right? Wider implications.
Exactly. The argument in the piece is that this kind of downgraded chips away at the U.S.'s perceived economic leadership. And this is happening at a time when, emerging markets and other countries are already actively exploring ways to rely less on the U.S. dollar for trade and reserves.
That whole de-dollarization trend you hear about.
Right. The source suggests that continued fiscal problems in the U.S. could give that trend more momentum, especially if, say, another agency were to downgrade further down the line.
Okay, so let's try and wrap this up. To recap, Moody's downgrade, coming after others, it really acts as this significant flag about the U.S. fiscal path. We're talking escalating debt, rising interest costs making it harder to manage, and this perceived lack of political agreement or will to change course.
Yeah, and it clearly caused some immediate jitters in the market, that volatility we discussed. But maybe the bigger takeaway from the analysis is about those longer-term risks, the potential for permanently higher borrowing costs for the government. And perhaps more profoundly, this shift highlighted an investor behavior that moved towards assets like gold, driven less by inflation, according to the source, and more by, fundamental questions about the long-term reliability of traditional paper assets and government debt.
It's fascinating how this deep dive, just following the threads in this one source, really connect domestic policy choices, or lack thereof, with immediate market reactions, and then ripples out to America's whole economic standing globally. So let's leave you with a final thought, something to mull over based on what this article suggests. If confidence in those traditional bedrock assets, currencies, government bonds, is genuinely starting to fade, as the analysis implies, what does that fundamentally change about how we should all be thinking about economic stability, maybe even our own investment strategies in the years ahead?